Hello everyone, Aditya Chopra here from AKC Capital, and it gives me great pleasure to have another interactive series with Mr. Ashish Somaya, CEO of Volatility Capital Asset Management Company. This is again one of the series in which we try to have a perspective on the markets, and more so in these times when we are seeing heightened volatility. So we are going to see this time how we can actually manage returns with volatility in these markets. So over to Ashish. Thank you for being part of this session. I'm grateful for your time.
Thank you Aditya. Thanks for having me.
Pleasure having you here. So Ashish, my first question to you would be, when you look at Volatility Capital Asset Management Company, active share has been a key component of your strategy to generate alpha in your portfolios. So for our audience here, how do you generate that active share, and what is the strategy behind it? If you can elaborate, it will help us.
Sure. So Aditya, as a lot of our listeners would appreciate, after having interacted with you and having some experience of investing in mutual funds, it's obvious that everybody invests in active mutual funds with an aim to outperforming the benchmark. And needless to say, if you want to beat the benchmark, you cannot buy the benchmark, right? If you want to beat the benchmark, your portfolio should have certain elements which are, at a divergence to what the benchmark is doing, at a deviation to what the benchmark is doing. And usually, how much your portfolio deviates from benchmark is what is alluded to as the active share.
Correct.
Now, talking about active share in our portfolios, typically they would be north of 60%, meaning that if you just generally go by, there are no rules out here, but if you go by rule of thumb,
right,
typically any portfolio which is just say 30-40% active, one can say is too close to benchmark. It's like kind of closet indexing kind of thing, and anything which is say above 60% active vis-a-vis benchmark is considered to be a really active portfolio. But clearly, there are two ways in which managers tend to create active share. One is that they take the entire investment universe and straight away start slicing and dicing it.
Correct.
So there are many managers who would say that I am a specialist for small and mid caps. There are some managers who say that I buy value or growth.
Right.
Some say that they buy a subset of value which is contra or cyclical. Some people buy defensive stocks, some buy cyclical stocks.
Right.
So everybody has their set of preferences, which causes certain biases.
Right.
So one way to create active share is to slice and dice the market with the examples that I gave you, which means that you would very quickly narrow down your universe and then say that your research functions only on that narrowed down universe.
Absolutely.
And then the stock picking. So this is one way in which I have seen active share is created. Nothing wrong with it, but basically what happens is that when you slice and dice the market right at the top and narrow down your universe, it means that you're going to operate only in a small part of the market. And that when macros change, which part of the market is tailwinded and which part of the market is headwinded, that kind of tends to change. And that is why you can see very clearly that in the mutual fund industry, the best performers change every 18 to 24 months. Now, we also have a high active share, but at White Oak, the way we create active share is not to slice and dice the universe. We start with the whole universe.
Right.
We only say that, okay, we need companies with good governance. That's it. So we start with the whole universe. And so let's say we say that everything above 1,000 crores is part of our universe. So you start with 900 companies, and then when you say you want good governance, you used to be left with 650 or 700 companies. So basic point is that we have a high active share, but we create that active share by operating on a very, very wide universe, and our active share is created through a large variety of granular positions. Generally, when you have granular positions, people might think that is it that there is lack of conviction? Why do you have so many stocks? But the idea is to create a very high active weight, but with granular, diverse exposures. But I can tell you one thing, that needs a very large research team.
Absolutely.
So we have more than 30 people in research.
Right.
In fact, for every sector we have sector leads, and under every sector lead we have 4 or 5 people. Just to give you an example of BFSI, for instance, we have about 6 people who cover 108 companies.
Okay.
So high active share to ensure that it doesn't come with high active risk. High active share which is built through granular positions,
right.
But then all of that is backed with lot of work on research. I can tell you that the amount of research our team would do and buy 0.75 or 0.8% exposure, there are very many people who could buy maybe 3-4% with that. But we ensure that we have in-depth coverage and a very, very wide coverage.
Great. Thanks for your input on that. No, I think, you rightly said that while active share is important to generate alpha, it is natural to assume that any strategy which entails higher active share would come with a higher proportion of active risk as well, right? And again, when you look at the I remember in one of the sessions where we discussed earlier, somewhere I think White Oak is also trying to ensure that while there's a higher active share, you also try to bring an optimum level of risk. It may not be very active risk, but I would say it would be more on a medium zone.
So absolutely. See,
so how do you manage that?
Yeah, exactly. So that's what I was saying, that having a high active share is a must if you want to outperform by a margin, right?
Absolutely.
But how you go about creating that active share will determine how much active risk you are actually taking.
Correct.
Right? So the idea is, like I was mentioning, that if you create your active share by choosing to operate in some segment of the market,
right,
and thereby obviating your participation in many other large parts of the market, that active share is going to come with very large active risk. Because market is such, like in Hindi we say, band ghadi bhi din mein 2 baar sahi waqt dikhati hai. So you cannot eliminate anything.
Yes.
Right? So when you create active share by eliminating vast parts of the market, that active share comes with high active risk.
Right.
But when you create active share by minimizing biases, by saying that I'll operate on the broadest possible coverage of the market and deploy that many people to research that big universe. Let me put it lightly, let me put it in a different way. We all have appeared for competitive exams. Correct?
Absolutely.
So may it be joint entrance exam of IIT, may it be CAT, CET, so many. Now, all of these competitive exams come with very, very large syllabus. Right? Now, if you say that, okay, syllabus is too big, let me cover 6 or 7 parts of the syllabus very well, and let's, 3-4 can't do much. Right? Now, if the exam comes from those 5 or 6 parts which you are good at, you'll be a hero. But if it comes from the other 4-5,
right,
then you're out. You're out of the, you'll say out of syllabus, can't do much. But if you cover broad part of the syllabus and try to say that, irrespective of what comes in the paper, forget hero or zero, irrespective of what comes in the paper, at least let me ensure that I consistently pass. Right? So those are 2 different strategies. Right? In one, you could be topper, but you could be out. And the other one, you are covering broad parts so that you are at least consistently having a high probability of passing.
Absolutely.
Right? Now, you understood this is related with the whole active share creation, what I mentioned, but the most interesting part, the job of the market is to ensure that every year or 2 years, not the question paper, the whole question bank changes every year or 2 years. Right? So it matters how much of this, if you want to be consistent and if you want to consistently outperform, you cannot have high active share with very high active risk. Right? If you want to consistently pass, if you want to be consistently better than benchmark or consistently better than averages, then you need broad coverage of the syllabus. That's the limited point.
Great. And I think for your viewers here, I think Ashish has brought out 3 very important points, and I'd like to re-emphasize those points. And I think these are about having a broader coverage. And I think you had a brilliant analogy when you kind of preparing for competitive exams, and IITs is always an example.
I have more analogies, like I gave you an example. Say nowadays, people are watching competitive cricket, right? You have IPL or you have World Cup. Right? Now, I don't know if are you like a cricket buff like me?
I do watch cricket.
So you must have noticed that any, when you play limited overs cricket, any good cricket team, right? A balanced cricket team, generally they would have 5 batsmen or 6 batsmen, maybe 3 bowlers, and maybe a couple of all-rounders. And usually the wicket keeper is a batsman. Right? Now let's say, Aditya, we have to make a cricket team. Okay. And I tell you that, Aditya, I think that tomorrow I can feel it in my bones. Tomorrow we're going to win the toss. And I think this pitch is going to play very well for batters. So let's do one thing. I'm quite sure we'll win the toss. We'll elect to bat. And we'll score 350 to begin with. and I think the pitch is going to work well for the batters. So we make a team where there are 9 batters, 8 batters and 3 bowlers, and we'll end up at the match. Now imagine, instead of winning, we lose the toss.
Right.
And instead of us getting to bat, the opposition elects to bat.
Right.
And we have to bowl.
Right.
तो वो हमको 400 रन मार देगा ना पहले.
Yeah.
Right. So you understand, you never make a cricket team with the assumption that you will win the toss.
Yeah.
Correct. You always make the cricket team with the assumption that we might win the toss, we might lose the toss. The pitch might be flat, the pitch might turn. We might be made to bat, we might be made to bowl.
Yeah.
Right. So the pitch, the toss, these are all macros.
Right.
You cannot build a cricket team assuming that you will win the toss.
Right.
The same way, you cannot build a portfolio. You cannot start building active share. You cannot start eliminating vast parts of the market thinking this will work, this will not work. Right? So the job of the market, or the job of the market, like I said, is to make sure you cannot predict the toss. The job of the market, like I said, is to keep changing the question bank. So you cannot be, predetermined about anything. So you need to cover you need a team which has broad capabilities. The same way you need a portfolio which has capability to perform in all kinds of market conditions.
No, thank you. That was the second analogy, and I think just to emphasize the key points you've brought about, the broader coverage. You've brought out the various essence of the process itself somewhere. I think if you have the right process, then you eliminate any unexpected outcomes. You're prepared for it's more like a middle path strategy, where you, and the third element which you brought about, which you clearly, is that how can you build that element of consistency. Right? Because I would rather invest in a portfolio as a client which can give me a level of consistency rather than something which gives me a sudden shock. Right?
Absolutely.
And the middle path is always a right, because you have predictable outcomes, and that's, I think, what clients would also be needing in these volatile times. So thanks, Ashish, for the brilliant analysis that you brought forth. And now that people are worried about FI outflows, and we worry about a crisis in Middle East, US is financing 2 wars. There's a lot of volatility and global uncertainties, which brings us to the time test question of systematic investment plans, or SIP.
Right.
And I think White Oak has been one of the AMCs which I've seen. They've done some research and really some data analytics around that. And that's something I think would be good to share with our viewers. So which brings me to the question here, that when you did this study about SIPs, you have clearly highlighted as part of the research the 3 phases of SIP. And I can, if I get the terms right, there's a kind of the early phase, the patient phase, and then the long only wealth creation phase. So if you can tell us something about these 3 phases.
So typically what happens is that first of all, why do we recommend that people should invest in equities by way of SIPs? Correct. There are clearly 2 reasons for this. One is because when you enter equity markets, right, everybody has this unwritten condition, or everybody has this unwritten requirement in their mind that while they know that markets can be volatile, sometimes they go up, sometimes they go down. But generally when people start investing, there is a implicit or unstated condition that in the past whatever has happened, that's fine. But if I start investing today, then from tomorrow the market has to go up. Right? Because they don't want to see any, and it's true, you're just starting to make an investment and suddenly you see it's down 5, 10, 15, 20%. People start to lose perspective. Correct. So what happens is that because it's very difficult to time, that is the reason why we tell everybody to do SIPs. Correct. Now when an SIP gets started, I think how it starts, let's say you put 5,000, 10,000, 20,000, whatever per month you're putting. Let's say 6 months have gone, and let's say putting 10,000, so you put 60,000. Now in the early phase or the first phase is when the confidence either gets built or it gets lost. Correct. So if you put 60,000 by way of 6 installments and you find that the value is 50,000, you kind of somewhere your motivation to continue gets called into question. Absolutely. Correct. So that is the first phase of adjustment
Yeah.
and where people. Second is that ultimately what happens is that when people have a bad start, we have tried very hard to explain to people that a bad start or a slow start is a good start.
Is a good start.
Right? So because conceptually, let's understand one thing, that when you are in the early phases of an SIP, you just started putting money. I put 10,000, market goes up 11,000.
Right.
Next month I put 10,000, market goes up more 22,000. Now what is happening is, when I'm starting to put money, if the market starts going up, it means that my installments are going at higher and higher NAV.
Yeah.
So that many less units. So in my journey of next 5, 10, 15 years of SIP, in the initial stages, when I've just about started, in 1 year you'll put 12 installments, right? When you just about started, if the market shoots up, it means that in the initial period, your units are coming at higher NAV,
Yeah.
right? But now see the converse. My journey is 5, 10, 15 years. It's a long-term journey.
Yeah.
I just started. Forget 12 months. For the first 36 months, nothing happens in the market. In fact, let's say market goes down by 10, 20%.
Yeah.
In those cases, the early phase of that person's SIP, that would be very troublesome. In fact, a lot of people might just throw in the towel and say, okay, let me not continue. But that is actually the best thing that can happen, because when you are starting your SIP journey of 10, 15 years, in the first 3, 4 years, if the market does nothing, and let's say it keeps falling or it goes nowhere, it means that your money is being invested at a low NAV. You are accumulating units, your money is invested at low NAV, and then on a back-ended basis, if market goes up, by then you have accumulated more number of units and you get large appreciation on large number of units. On the other hand, if the market keeps going up the moment you invest, that means you entered at higher NAV on an average, you got lesser number of units, and in the long term, whatever return will come, that return will come on a lower number of units. Right? So I think that it's very important for people to live through this. The first phase of uncertainty, and then the second phase of consolidation and gaining confidence, and the last phase of ultimately seeing non-linear or exponential benefits of compounding. Right? So it's very important. It's very important to see the data in the right perspective. A lot of people want instant gratification. I started now it has to go up. And if your journey is 15 years, 20 years, then why do you want the market to go up in the first 3, 4 years? Right? In the first few years you invest, and if the market gives below average, in future it will give you significant above average.
Yeah, absolutely. I think that's a very valid perspective. And when I was going through the research which White Oak has done, I think the key point for our viewers also is that when the times do get tough, and which you brought out clearly in this conversation, that's the time you really need to stay put. And that brings in the second phase, which is the patient phase, which you because when you stay put and really spend that 5 years in the patient phase, then you enter into a wealth creation phase, and which is clearly like a 15-year and a longer journey.
Absolutely.
So I think key pointers for our viewers are that start early. SIP is a great way to invest in the markets and equity markets. Be patient and look and be there for a longer time horizon, because that really results in long-term wealth creation.
In fact, like we said, if you have a bad start or a slow start, think counterintuitively. In fact, that is good for a longer journey.
Absolutely, that's correct. And I think if I remember right somewhere, statistically speaking, when you invested in equities, I think for almost a decade, I think your risk measured in as a measure of standard deviation,
it goes down.
It goes down substantially, if not nil. But so I think we need to build.
So if you start, just imagine, visualize like a cone, right? So let us say that if you're somebody who has always invested for 1 year, so whenever you invest for maximum 1 year. You dabble in, dabble out, right? Now, if there are a bunch of people who have always invested for a 1 year time horizon, you tabulate all their experiences and observations. So if you have invested in equity for a period of 1 year on an average, let's say all of us put together, everybody has done a variety of experiments, but whenever we invest for 1 year and get out. So if you tabulate the experiences of all the people who have always stayed there for 1 year, the range of outcomes could be as wide as plus 40 to minus 40, right? You go to 2 years. the range of outcomes will narrow down. You go to 3 years, the range of outcomes will narrow down further. The moment you cross 7-8 years, you will find that there are no negative outcomes. Anybody who has invested even in the index for, they would have made money, no instance. So the moment you go 10 years, 15 years, 20 years, what you will find is that the range of outcomes becomes very narrow.
Very narrow.
In fact, the worst return, the best return and the average return, all of them kind of center around one particular number in the range of 12 to 15% kind of number. Yeah. So the clear point about elongating the time horizon of investing is basically that irrespective of when you enter and exit, if you stay for a particular amount of time, the range of outcomes actually tends to narrow down.
Yeah. And in these times with heightened uncertainty, and we talked about various global factors, domestically we are staring down election coming in May, so there's so many things happening. I think multi-asset allocation, and that's something you guys you launched your funds in that space. It's been a time-tested strategy in terms of, I would say, better risk-adjusted returns. So, any take on this in this strategy on how really the multi-asset allocation works?
See, I think one of the tenets of being a good investor, successful investor, or being somebody who can persist with the market for long period, and you never get thrown out of the market, or you never make mistakes in investing. One of the key tenets is that you should be somebody who is probabilistic.
Yeah.
See, who puts 100% of the money in equity?
Yeah.
Or who puts 100% of the money in bank deposits, or who puts 100% of the money in land or real estate, right? These are the people who are fully convinced and not open to any other possibilities, eventualities, or any other ideas, correct? If I say that, no, Aditya, I invest only in equity, nothing else works, it means I am too deterministic, that equity is the asset class to be in. Yeah. But I'm sure you'll agree that's not true. There are certain circumstances where fixed income does much better than equity. Yeah. If you see within equity, there are circumstances where American market does better than us, or global market does better than us. There are certain circumstances where we do better than them. There are times when gold actually suddenly starts to shoot up, correct? So we all know that when macroeconomic conditions change, like we said even when we were discussing equity and active share, we said that when macroeconomic conditions change, different segments of the market, different styles and different sectors will do well, right? So you should be open to all possibilities and you should have a broad start. Same applies to asset classes also, right? I mean, at different points in time, different asset classes do well. Now, if you are somebody who is too deterministic, whereby you do not practice asset allocation, and your entire investment is lopsided in favor of any one or two asset classes, that means you are too deterministic. And the market, the market is something, the job of the market is to break every determinate person's determination. Right? That's when it brings out all these kind of scenarios. So the point is that for anybody to be consistently engaged with markets and to practice investing over a long horizon, they need some amount of diversification in their portfolio, and they need exposure to broader asset classes like domestic equity, global equity, fixed income, gold. And multi-asset allocation funds are the ideal kind of vehicle to ensure that you get very, very good risk-adjusted performance. See, ultimately, when you do debt, equity, and all of this, on an average, what are you going to get? On an average, you get high single digit or low double digit. Yes, your equity portfolio from time to time might give great return, but from time to time, equity also gives negative return. When it gives great return, people become very greedy, and when it gives bad return, people become very fearful and they want to bail out. But what is the way to ensure that you are consistently there? The way to ensure you are consistently there is to run an asset allocated portfolio, so that on the average, you get good returns and less volatility. Correct?
Absolutely.
So I think multi-asset allocation funds have a great role to play in delivering optimal returns, but with low volatility, and at the same time spreading out your investment across 3-4 different asset classes, which will deliver this. And I think other important thing is that when do people make mistakes in their investment? People make mistakes in their investment when they react emotionally. Right? But then the question is, when do people react emotionally? People react emotionally when they are exposed to extremes. So multi-asset fund is a very good way to ensure that our investors are never exposed to extremes and they can stick to a journey.
Absolutely. And thanks for that perspective. And I want to bring out an interesting, part of your study, which White Oak did, and that was about, fixed income generating a certain portion of returns with a volatility of around 6.97%.
Yeah.
And when your team did some number crunching,
Yeah.
you assuming an asset allocation between debt and equities.
Yeah.
I think somewhere we looked at that if you have 75% fixed income, 25% equities, with the same level of volatility, you are generating incrementally higher returns. That was one part.
Absolutely.
And when you add a third asset class, I'm just adding that to the same
Like
question,
gold, yeah.
like gold, and that's a classic case in the Indian context. Then with fixed income at roughly at around 55%, you again kind of were able to incrementally increase the returns.
Absolutely.
So my question to you is that what is your take on generating incrementally higher returns with the same volatility?
Yeah.
So if you can bring some learnings from
let
there.
Let us take a layman question or a more pedestrian question. Say, for example, if we were to ask any of our viewers or investors, if we ask them, a lot of times people are conservative investors. They say that they put money in a short-term bond fund or a GSEC fund or an income fund or dynamic bond fund or something, right? Or some people even buy bonds, correct? Now, if we ask someone that when you put money in a bond fund, obviously a bond fund has an NAV, correct? So if you tell someone that over the last 15 years, if you put money in a government securities fund or an income fund, okay, the rolling average, for 1 year average is say 7.5 to 7.7%. But obviously that bond NAVs also fluctuate.
Interest rate risk.
Because of interest rate risk. So the average return is say 7.6, 7.7, correct? But whenever somebody uses the word average, it means there is a minimum and a maximum also associated with it. That's where you come at the average. So for a typical income fund, as you know what happens when interest rates go up, the NAVs kind of get headwinded and they don't move much or they decline. When interest rates go down, the NAVs become tailwinded and you see big appreciation. But over the last 15-20 years, if you take 1 year rolling average, for a government bond fund or income fund, 1 year rolling average will be 7.6, 7.7%. And when you factor for minimum, maximum and average, you will find that the worst case return may be 1 or 2% and the best may be 14, 15%.
Absolutely.
Correct? Now, let's ask this question that that this is your experience when you put 100% of the money in debt. Average 7.6, 7.7, worst couple of percent, best 14, 15, something. That's your range. Now, I ask you a question that if we were to start replacing this debt with equity, so let's say you reduce the debt from 100 to 90 and you take the equity from 0, you put 10% equity.
I think the general notion would be that you're increasing risk in the portfolio.
Yeah, so most people, absolutely. So most people will answer saying that, oh, I am a fixed income investor. How can you add equity to my portfolio? If you put 10% in equity, I don't know what will happen to the return, but definitely the risk will go up. But if you statistically do the whole analysis, that if you do 90% debt, 10% equity, in fact what happens is return goes up a little bit, but the volatility goes down because of low correlation. Right? If you move it to 20% equity and 80% debt, you will find that return goes up another notch further and volatility doesn't change much. Now you asked about 75-25. By the time you get to 75-25, what will happen is, I told you that for debt itself, there is some inherent volatility. So you say that, okay, let me not reduce the volatility. जो debt में volatility था, उतना तो मैं accept कर ही रहा था. That much I was willing to accept. So for the same volatility, if I keep adding equity and arrive at the same volatility, what is the maximum return I can get? The shocking fact for most people who don't do all this statistical analysis is that if you add equity, you can enhance the return without impacting the volatility. For the same volatility of a bond fund, you can add equity and you can get higher return. And carrying this further, if you actually to debt, you started adding equity. Now you reduce debt further and introduce not more equity but introduce gold. right? So if you add say 20%, so you bring it to 55% debt, 25% equity, and 20% gold. You will find that for the same volatility, debt and equity gives better than debt. For the same volatility, debt, equity, and gold gives better than any other combination. And this is actually the statistical basis of why we have multi-asset allocation funds.
No, absolutely. And for our viewers, I think the point Ashish is saying and we are trying to make here is that while we all do the right asset allocation, especially when you have multi-asset allocation, that can significantly improve your risk-adjusted returns, right?
Absolutely.
And a quick question just to add on, is that, we did some study on, having 4 asset classes as well. And that's something when we brought in, let's say global equities in the portfolio. And there was a significant point, concept which came out, and that was about correlation. So when you talk about correlation, especially in a multi-asset allocation, how significant or how important is correlation in your, in this particular multi-asset allocation strategy?
Actually, if you see any literature on multiple asset allocation or multi-asset allocation, any literature you see, what tends to happen is that it does, like you rightly said, it speaks about correlation. Because you are practicing multiple asset allocation to ensure that you are invested in asset classes which have low or no correlation, right? So
all your asset classes are not moving the same
not moving in tandem
in different times.
Absolutely, they are not moving in tandem, right? So what will happen is that, but for this multiple asset allocation to function, you need the allocation to all the asset classes to be unfettered, and to be able to get to a range which is more equitable, right? So say for example, if you take statistical data, you will find that the correlation of equity with gold is low and negative, right? It's a low and negative, but that is relevant only if you have 1 rupee of equity with 1 rupee of gold. So the allocation needs to be unfettered, and based on market parameters, based on valuation, the allocation should shift and find its own balance to counterbalance each other, right? That is important. The second thing is that when you look at equity, like you rightly said, as many asset classes that you can bung in, the chances are it will help you curb the volatility or control for volatility and give you return. Correct? So let us say when you add global equity, what will happen is that there are very many circumstances when Indian equity, like 2012 I think was a year when Indian equity did very badly, but US equity did well. Correct? So there are very many circumstances where within equity also it makes sense to be outside. Plus, the correlation of Indian debt with global equity will be different from the correlation of Indian debt with Indian equity. Right? So the basic principle is that more the number of asset classes, more the number of uncorrelated or low correlation asset classes that you can bung in, and you can arrive at right proportions, you are likely to enhance return without impacting the volatility too much.
No, absolutely, and I think somewhere from this would be fair to assume that when you have I think portfolio rebalancing also becomes important. Like I'm just inferring this from this conversation, and becomes all the more significant that if you're a long only investor in line with your strategic asset allocation, that's one part. You're also doing some tactical asset allocation with some short-term opportunities. All these also become important in this whole scheme of things. So the key takeaway for our viewers here is that do the right asset allocation basis your risk profile, and that could really give you better risk-adjusted returns. Which brings us to the next part of my question, and I wanted to kind of remove some myths about SIPs, and especially that it's such a incremental part. Now that in India, I think the SIP was 16,000 crores per month. And it's going to probably increase only in the times to come.
Absolutely.
So you've done some very detailed study as far as the SIP is concerned, and this fundamentally had 3 or 4 parts of it. And one was that what could be the option in time to start the SIP in a month. Second thing I think we covered was the frequency of SIP. We've also covered that. How long should we keep the SIP? And I think the most important for our viewers here is that, should I do an SIP between a large, mid or small? What could be the right way? So statistically, what were the outcomes here in this study? If you can share.
So, I think why we share such studies, and we could maybe urge you also to share it with the widest number of investors possible. The reason why we publish these kind of research papers or documents is because what I've seen is that people in right earnest do want to start investing, right? They do want to plan for their future, and people do understand that investing in equity mutual funds by way of SIP seems to be like the way to go about it. But what I've also noticed is that despite in right earnest wanting to start, the fact is that there are too many decision points which come up, and that ends up complicating and confusing people, right? So if you were to go to a mutual fund website, or if you were to pick up a mutual fund form, right, and say that okay, I want to start an SIP, the point is it will ask you, okay, which day you want the debit to happen, which day you want the money to go.
You have that.
And guys, our industry is notorious for complicating. Because it is well known, well documented research that when you give people too many choices, they postpone the decision.
Absolutely.
And in fact, when you give people too many choices, even if they make the decision, those decisions are not very sticky. And some of those decisions will eventually cause regret. Right? But if you narrow down the choices, then people can make more effective decisions. That is the reason why we publish this research, that our finding, on your question, our finding is that it just doesn't matter which day. The best day is today. The best day is the day you receive your salary. Correct? So there are no such biases that you'll get higher or lower return depending on which date the debit goes. Correct? The second thing is, again, if you take long horizons like 10 years, 15 years of SIP tenures, it doesn't matter whether you do weekly and fortnightly and all. Basically, monthly SIP, most of us receive income every month. If we do the things right, then our savings will be left with some savings. Correct? So I think any day of the month is perfectly fine, and monthly frequency, fortnightly frequency and all, don't labor yourself with it. Just a monthly frequency is fine over a long period of time. But yes, there is definitely one thing to keep in mind, which is that generally it has been seen that the ability to generate return seems to be higher in the mid-cap kind of space.
I think that's
over
a
long
very
period of
important
time.
point that you're sharing for our audience here.
Yeah, because past experience tells us that look, it's fundamentally also true that the fastest growing segment. So because what happens is that small cap companies are a very, very large universe. There are hundreds. Right? And generally speaking, small cap being small cap, say 3,000, 4,000, 5,000 crore market cap means these are companies with profitability of 50 crore, 100 crore, 150 crore. It's not like they are small, but the point is that from perspective of track record, longevity, sustainability, they might be belonging to industries which are still smaller and nascent. Multiple reasons why small cap is riddled with volatility and riddled with risk, plus governance can be a question. On the other hand, if you see large cap, what is there in the large cap index? Most of them are globally associated sectors like steel, metal, commodity, oil, right, technology, and so many of those. And then there are banks and FMCG. So generally you expect large cap grows at the nominal GDP growth rate kind of thing. But wherever the action in the economy is, correct? Like for example, people say that India is going on to becoming from a lower middle class to a middle class country. It's well known that when you move from lower middle class to middle class, your top priority is saving, investing, insurance, wealth management, those kinds of things. And people want to look better and live better. Now, if you take the non-bank, financial markets, that's the example I gave, they all are mid-cap companies. If you say people want to look better and live better, then all the quick service restaurants, the food, apparels, footwear, beauty products, consumer durables, all of those are mid-cap, right? If you expect growth in real estate, forget the big cement companies or the big real estate companies, but all real estate ancillaries are mid-cap companies, right? So I think, if you see government's production-linked incentive, right, whether it is auto ancillaries, whether it is electric components, whether it is, chemicals, pharma APIs, all of those are also mid-cap, right? So I think the mid-cap universe is rich in terms of diversity of sectors, within sectors diversity of companies, very happy hunting ground for alpha generation, and at the same time inherently, tailwinded in terms of its growth. So maybe that's why over periods of time mid cap seems to show, in the past also it has shown, and in the future also it seems to demonstrate a lot more potential.
Well, thank you so much for sharing your views here. Just as we conclude the session, I would just like to bring in 3 important points for our viewers to conclude this session. And I think the first part is, when you're building your portfolio strategy or your portfolios, have the right asset allocation in line with the risk profile. That could be point 1, that broadly is in line. Second, I think, which we can take away from this session is that have an eye on rebalancing a portfolio at regular intervals of time. This could be in line with your strategic and tactical asset allocation also, so that you book profits on time and realign your portfolios. And third, and the most critical part of our conversation, is that do start an SIP as soon as possible, and that day is today, right now, at the moment. And I think that's a very powerful way to build long-term wealth. So thank you, viewers, once again for this session, and thank you, Ashish, for taking time out for this interactive discussion.
Thanks for
Thanks to you and your team.
Thank you.
Have a nice day.